Hello and welcome to this session. I am your instructor, Ms. Alia Francois, and in this session, we're going to talk about financial statements and budgeting. Now, if you're in the position where each month your expenses always exceed your income and you have to use credit cards or your savings account to meet your expenses, this might be the most important session for you. Now, just as you organizing your financial records to know exactly what your numbers are saying, it's very important in the financial planning process. Compare it with going to the doctor. You want to keep in good health, and you have to know your numbers. You must know your numbers. Right, your blood sugar, blood pressure, and these sort of things. The same thing applies with financial management. You have to be in a position of knowing your numbers so you know if you're doing well, what needs to change, what you need to work on, especially in tracking your expenses. Now, the financial planning, this process, it's not an easy one. It will require time and effort. Just like everything else that, give you good results, it will require some work. Let's relate it again to your health. If you want to improve your health, what do you have to do? You have to change your diet and exercise and incorporate vitamins and a whole lot of things, right? And it will take up time. It won't happen overnight, right, for your financial health to improve. What about your fitness? If you want to get well, fitness, you want to do better, you want to look better, it will require a lot of exercise, a lot of work, and you'll take a lot of time before you see the results. The same thing applies with financial management, money management. This step I'm teaching you, this process, as I said, it's a long process, but it's important if you really want to see your financial situation improve and want to achieve those financial goals that you would set. Now, the three main components of money management, and money management is managing that income that you have and how it is spent, that they all may be able to achieve, all this process, you'll be able to achieve your financial goals. All right, it's not just making money and spending money, it's leading on to achieving some type of goal. The first component is financial documents, storing and maintaining your personal financial records and documents. So there must be some system. In this step, you're going to build a system where you're going to file. You use an accordion, you use a box, you use a container, whatever you can find, and categorize them and put all your documents, such as your tax documents, your employment documents, such as your contracts, your TD4s, your job letters, whatever, you put them in one place or a folder, right? You're filing them. Your personal documents, your birth paper, passport, and all your NIS numbers, these numbers, all those things, you put them in file order so you have them track your bank statements, your insurance policies, your retirement plans or as policies, your other investments, stocks and bonds. Well, these things have cash value. So the cash value items or your financial items, you want to probably use a safety deposit box at your local bank or so, or somewhere very secure, right? A safe or so. The second component of money management, what we're going to look at is financial statements. So remember to prepare those documents. Make sure you have your documents organized. This is your first task. Don't attempt the next task until you have that. Set aside some time to put your documents in order, right? Then the second step is your financial statements, preparing a balance sheet, cash flow statement on a regular basis. This is the statements that is going to tell you your financial position. It's not going to improve your financial position, but you'll be able to look at it and know how well you are doing. Just like businesses, they do these financial statements because They don't just want to run business. They want to know that they're making a profit, right? They're doing very well with their business. And they also want to monitor what they can change, right? Same thing applies. How are you achieving your goals? What is keeping you back? These statements will help you. When we finish with the statements, we'll do budgeting. Now I'm going to go through a live example with you. I have with me, so these are the statements, the balance sheet, cash flow statements, and the budget. So I have created some statements format, and I'm going through it with you. So this is the Excel. This is on Microsoft Excel. My favorite tool. Here we have a balance sheet. So your balance sheet is going to tell you your financial position, right? Financial position means how much you owe, how much you own, right? In terms of dollar value. This is how you prepare your balance sheet. We list the assets first. Now I've categorized the assets. Liquid assets. Liquid assets would be those assets that can be converted to cash very easily, right? Within a day or two. So you might have cash, checking account balances, saving account balances, money market fund balances, certificate of deposits, current value of saving bonds, cash value of life insurance, cash value of any annuities, right? These are your liquid assets. Oh. Then we go to real estate. Do you have any real estate? Right, so the first set of balances, how are you going to get them? They will be the balances you have in the funds, right? For your insurance and annuities, you can call up your agent and ask them what's the current cash value, right? Your saving bond, you will go on your stock exchange and see what's the value of that bond. If it's a in the local market, if it's a corporate bond with a company, well, or a government bond, you would call up the agency as well and see what the bond is selling for. We learn more about bonds and stocks. Don't get confused, as a form of investments, right? Real estate, you only look at the market value, not really the price you paid for the house. What's the current market value? And you can estimate it by looking online or asking questions around your area, see what the houses around you or compared to you are selling for, any other investment properties or so. Then your personal possessions, cars, household appliances, jewelry, any collectibles like art and, stuff like that, any other personal items with some kind of cash value on it. This is what you put here. Now the value for your car would be in not necessarily the price you paid for it or the balance on the loan, but how much your car could sell for. And again, the internet helps us, right? Household appliances and furniture, again, not necessarily what you pay for, but what you can get for it now, because if you bought a television 3 years ago, you can't sell it for the same price that you bought it for, right? So what it could sell for at this time, same thing with jewelry and collectibles, you get a reasonable, make sure the cost you're putting and the values you're putting, not cost, the values you're putting are reasonable. Same thing with stock markets. Value, you see the value of your portfolio. Mutual funds, what value you have as well, you put it there. And then you get your total assets. Total assets would mean this is the amount of value you have in terms of what you own, O-W-N, own. Then you go to your liabilities. So the liabilities comes in current and long-term. Current means they can be converted into cash within, they can be paid within 1 year, long-term over a year. So those stuff that has to be paid within 1 year, credit card balances, medical bills, taxes due, and any other loans or so you may have that can be paid up within a year. long-term car loans, mortgage, and any other. You get your total liabilities. This represents how much you owe. Take your assets from your liabilities, right? And you would get your net worth. So if our assets is 50,000 and our liabilities is 25,000, then our net worth is our assets minus our liabilities, 25,000, right? It doesn't mean that this is the cash that you have. That net worth is not the cash that you have, but it tells you over time what is happening to your financial position. Is it improving? The number is important, right? Is the number improving or it's not? It is looking real bad. So, for instance, you go to the doctor every 3 months, and if your blood sugar level is increasing, then the doctor would know, right? We need to maybe subscribe some medication, or you may have to change diet or something else. Same thing with the financial aspect. You look at your net worth or your financial position every 3 months. Is it improving? Is it going down? And then we can decide, or we have a strategy in which we can improve your financial position. How do we improve your financial position? You need to increase your assets, or maybe to decrease your liabilities, right? So on this side here, I have the steps. We list the items of value, starting with cash and so forth. Then we list total liabilities, and we subtract the liabilities and the total assets. Now, why are you calculating your net worth? Why is it important? Again, it tells you if your financial situation is improving, and increasing your net worth over time is favorable, it's good. But if it's decreasing, it's unfavorable. You may need some help or some guidance, right, to know what to do. You don't want to be in a position where your blood sugar is sky high and you didn't know it was, increasing. How do you increase your net worth? You set aside more money in savings and investing. That's the easiest way. So we got through the balance sheets. Have fun doing it. Now let's look at the cash flow statement. Cash flow statement tells us, we're preparing the cash flow statement to tell us how funds are flowing into our accounts, coming in to our possessions, and how they are going out. So we're really looking at our income and our expenses. So this process, you're going to do it over a month time. I prefer 3 months, but you can do 1 month. You can start with 1 month to get an idea how cash is flowing in and out of your life. So your income, we start with your income, gross salary. Gross salary is the salary before they take out taxes, right? You can make note of your taxes because they might differ every month, or maybe they don't. If they don't, you can just start here from net salary. So you have NIS, health surcharge, and so forth, other payroll taxes, then you get your net. From your net salary, what other income do you have? Do you get income from interest, dividends, gains on your stocks, gains on sale of your bonds, tax refund, income from any pensions? Well, if you don't have a salary, you might have pension, gifts. All of us do get gifts. What about alimony and child support? That's an income, extra income that comes in. You need to budget for that. And any other, right? This represents your total inflow of cash. So that's the first step. List all your sources of income for the period. Next step, list all the cash payments made during the period. Now I've separated the cash payments in two, right? So this process, you'll have to, keep your bills. I find looking at my bank statement help me because I use a lot of online or my debit card a lot. But for those cash transactions, try to use a budgeting envelope. I have a budgeted envelope I use for cash transactions. And those transactions where you don't get bills, you use an app. Use the app, take a picture, you write it down somewhere, right? So you can keep a little track. Try to do it for 1 month. So that will require you, like every day, to look at your spending, right? Before you go to sleep. Fixed expenses, rent or mortgage, right? That doesn't change. Fixed means it doesn't change. It's the same every month. Loan payments, internet service, cable TV, life insurance premiums, and any other insurance premiums that are fixed, right? Variable expenses, tithe and offering, car expenses, telephone, utilities, medical, food, at home, food away from home. I like to separate these categories for my clients because they've tried to lump food in one and then it's unable, it's the hardest one to track. So food at home, maybe groceries, and food away from home, right? Might be those things, street food that we buy. Personal care, such as pharmacy items, toiletries, such as grooming, laundry, any personalized care items, you put that there. Donations, every time somebody coming with a sweet box, a barbecue, something, right? We budget for that. Oh, I shouldn't say budget. Sorry, not budgeting. We're writing it down, right? Because it always comes at an expense. And if you don't cater for it, then our budget will be off. But we want to see, how many times we give in these things. Gifts, pets, credit card payments, home maintenance, right? Those things are variable. It doesn't happen every month, or the amount is not the same every month, right? So we put that there as our outflow. Again, you're doing this exercise, try to do it as comprehensive as possible for 1 to 3 months. So you have a track record of your cash inflow and your cash outflow. Here we're going to get from your total inflow minus your outflow, you're going to either get a positive figure or a negative figure, right? A cash surplus, everybody wants a cash surplus. But in reality, I shouldn't say in reality, but the majority of times I have seen everybody spending, most people spend more than they have. And what happens when you do that? It means you're living beyond your means, right? You are either using your savings to fund your expenses, your outstanding expenses, or you're using debt to fund it, right? If you happen to have a surplus, in some cases, there may be a surplus, then this amount can go towards your savings and investments and paying off your debts. And so it can increase your financial position and your balance sheet. So that's why you see the looking at the numbers and the management of the numbers is what's going to help you with this financial planning. I hope you can see it. Please try it. Then when we're finished with those, then we can create a comprehensive budget, right? A budget tells us it's a plan. It's a plan. It's a plan of what we're going to do with our money. Some people get paid monthly, weekly, quarterly. Sorry. Monthly, weekly. Yeah. Bi-monthly. So every 2 weeks, right? Yeah. Some people get quarterly, right? Or every 2 months. You plan your budget based on that salary, that income that is coming in. So if it's a monthly budget, yeah, you have your projected income. So you're not preparing the budget after the money come in and it's done spent. You try to fit everything in. This is done before time. And this is based on that cash flow statement that you prepare, right? That's the reality because you tracked it. So we know what salary, your projected income, projected business profits. So some people get, you have a side business, what profits you make, that's part of your income, right? For you to spend your dividend or your interest from other investments that you have, any capital gains on your stocks, any gifts received, birthday, or maybe somebody just gave you some money, right? Or you raise some funds, however it is, all that income must be budgeted for. Every dollar should be budgeted for. Then we go to projected expenses. So the expenses come from the cash flow statement or came from the cash flow statement, right? That's the fixed and the variable. But before we go to the fixed and the variable, we want to budget for our financial goals. I'm going to go through how we prepare those financial goals as promised, right? So financial goals, which they says, the financial experts tell you pay yourself, right? Pay yourself means you're paying towards your goals, right? This is kind of like your savings. So it's not just regular savings. So at the end of the month or at the middle of the month when you can't meet your expenses, you dip into it. The savings is structured. So it's structured for emergency fund, right? New car or car insurance, saving for investments, for vacation, for retirement, college fund. Some people might have marital fund, marriage fund, or wedding fund, I should say, right? Right, and then your expenses. I don't think I had entertainment there. I think I left entertainment out as a variable expense. You can put it in, right? It's a lot of person's life. Now your budget won't be the same as everybody else's own because we are different. And that's what I'm going to show you now, right? So through your budgeting, the most important part of your budgeting, right? List the expected income, list all the amounts of funds, list all expected amounts to fund your goals. We're going to go through that. List all the expenditure, determine whether there's a deficit or a surplus, meaning is it more income or is it less? More expenses, right? We really want a surplus. If we have a surplus, then we're good, right? We could take some of that money and put it towards our goals or paying off our debts. But should we have a deficit, right? So we're planning, that's not really planning, should we have a deficit? Then we go to our variable expenses. That's the first thing we do. We could say increase your income, right? You know, try to find a side business, try to work overtime, but that may happen in the long term. But if it's within 1 month or 2 weeks, first thing you might need to do is to go and look at your variable expenses and see what you could adjust, what you need to adjust. You need to adjust it so that you could live within your budget. If you don't adjust it, you're living outside of your budget. And if you continue in that pattern, and you would end up in financial distress, right? So start now if you haven't started already. Work on your budget and let your expenses fit within your income. All right. Budgeting now, as I said, is not a one-time thing. So to know if this budget is working, we need to record the actual and the difference. The same thing you go by the doctor, they tell you want to record the blood sugar, the blood pressure, record it every day. If you know there's a challenge, record it every day or every other day or whatever is maybe the case, so they can see the pattern. Same thing with the budget, you want to see the pattern. So when you prepare a budget, you want to record the actual. So remember I tell you about those financial documents. So you need to have a system where you're going to record the expenses and the income for a 3-month period again. So you can see the difference in your budget, how it varies. So you can get to the point where you have an accurate budget, right? You look to see where it varies. Variance means the difference between budgeted and actual, what actually happened. So that means, you gotta spend some time doing that. And then you can evaluate where changes may be necessary. Now, I want to come back to my slides to give you some points on implementing your budget. Right. So a lot of people prepare the budget. Budget can be written. Some people have budgets in their head. If your budget is simple, you may have 2 or 3 things on your budget. Yeah, you can put it in your head. But it needs to be in writing, or you can use an app, right? A computerized system where you can create a budget and record the actual. So for a lot of persons, I recommend the budget envelope. You see that envelope? You can have the cash. If you're especially now starting, put the cash in the envelope and you use as you go, right? So you put your bills in the same envelope. So you know by week 3, by week 4, a lot of people do it. You know where you are at, if you're over, if you're under, right? How much you could go again. For your savings, you need to select a saving technique. Payroll, deduction, or use those direct deposit, ACH, right? Send it to different accounts. I'm going to show you how you do organize that in a while. Track your expenses, yes. So again, there must be some form of track. You could use a spreadsheet, you could use write it down, you can use an app. Review your budget and spending every 2 weeks, every week or every 2 weeks. You don't want to wait too long because you could kind of forget what's happening, or it might be seem a little tedious if you're doing it once a month, right? So you want to review your budget and put your family in this plan, right? This is a nice way for husband and wife to build financial intimacy and to get your children to learn about financial management. If they're growing a home, seeing this thing done, most likely, more than likely, they will practice the same habits when they have their own. Now, quickly want to review the financial goals section. So your financial goals, as I said in the first session, your financial goals will be based on what you value, what you want out of life, right? It won't be based on what I want, or it should not be based on what you want or anybody else wants for me, or yourself. It should be based on what you value, what you want out of life, right? This is an example of goals. Might be my goals, no judgments. Emergency fund, so you list your goals. You list the estimated cost of your goals. So you must do some research, right? The estimated cost of research, because you need to make it realistic, right? Priority. So if your goal is to have a pool in the backyard, get the cost of it, prioritize it among all your goals. Which one you prefer or you want to achieve, first, second, third, fourth, 5, 6, 7. Because in reality, I may not be able to achieve all of them, but when you achieve one, it gives you encouragement to go and achieve the next one, and you keep crossing off the list or you keep adding on the list, right? So we prioritize them. Where we would put the money to. If you add this money, where I would put it to. I can't put it to all, so where should I put it to? Time needed in months. So here you set a time frame for your goals. Your emergency fund, right? You put a time, I have mine here, time in months, 12 months. A car down payment in 12 months. A college fund, 18 months, right? This will tell you the time frame of your goal, medium, short, long. Short, medium, and long-term goals. So you put a time frame on which you need to achieve these goals. Monthly amount. So the monthly amount, there's 2 ways you can do it. So some people do monthly amount. They want to see how much they need to save per month towards each of their goals. Now, if you have 20 goals, might be a lot of money. You may either have to extend your time or so, right? So to get the monthly amount, you take the estimated amount and you divide it by the time in months. So let's say I change my time to 6 months, my monthly amount increases. Right? I change my time frame of my emergency fund, my monthly increases, right? And then I get a total, will tell me I need to save 12,861 towards my 7 goals. Okay? It's not that I'm achieving them all at one time, but this is the amount that will go into each one. So when I'm finished with the emergency fund, I guess some of that will go into another goal, right? When I'm finished with the car down payment, this will go towards another long-term goal. I hope you get it, right? Please feel free to ask any questions in the comments. The second option, some persons they decide to have a saving method, consistent saving method. So emergency fund, the plan here is to put a one-time deposit from the tax return. So I guess the tax return will be enough for 6,000 to put towards that. And they know I achieved the goal. Where am I saving this? To this account. Let me go through the saving methods first. So that's one way to do it. You want to achieve your emergency fund, you could either budget for it monthly as this option, or you can, use 1 month savings. Instead of saving for all these things, take 1 month and put all into that and accomplish that, right? Car down payment in this case, they're taking 10,000 from their tax return and depositing 5,000 every other month, right? That's the strategy they're using. College fund, they're depositing 2,000 monthly. Vacation, 5,000 twice per year. Deposit 1,000 and 10,000 annually for retirement. New furniture, 400 monthly, 500 monthly. Right. So again, you have the two methods. You either save towards your goals monthly or you save one by one. You put your strategy, however you want to do it. But you have the both methods to use. You need to save into account. You can't put all your savings into one account. It'll be kind of hard to track, if you're there yet, how far you are from your saving goals, right? And different accounts, so we're going to learn about interest rates, the time value of money, interest rates, calculating interest rates to know where's the best place to start our saving goals. And we're going to do a session on investments, right? If your goals is to really invest. So here we have, where the emergency fund will be saved. You can see the interest rate right now at that point in time. So you may have to call the institution or check your financial statements or check the company's website or their financial reports and see what interest they're being paid. Credit union, bond fund, where this money will be deposited or saved to meeting towards these financial goals. Now you would see here, if you're looking at as well, that in planning your investment, again, you must know your financial goals. So you would know what you need to use to save towards the investments, right? And then I have a column here for time value of money. We'll go through in the next session. I'm going to go through time value of money and I'll show you, what's the value, what's this 500 worth in the future, which is 12 months from now, right? That's it for this session. If you have any questions, please put in the comments, like, and share. See you in the next one.